Good morning, XRP community. The conversation around XRP as the chosen liquidity instrument just got louder. New interviews, public shoutouts, and industry pivots are piling into the same narrative. Ripple is building rails that can serve banks directly, while Swift explores its own path. Today we separate the headlines from the mechanics, examine what ETF inflow talk could mean for day one liquidity, and outline the practical signals that would prove this thesis on the tape. Let's start with the big claim. XRP does not need a formal partnership with Swift to access Swift banks. That statement sounds provocative until you unpack how payments actually move. Banks do not live on a single rail. They connect to payment hubs, core banking systems, and third-party providers that can speak multiple languages at once. Legacy messaging, ISO 20022, tokenized settlement, and more. If a bank's internal stack is wired to route flows across different networks, it can choose the best path per corridor, sometimes messaging on one rail, settling value on another. In that world, Ripple's strategy is straightforward. Integrate directly with banks and payment vendors so liquidity can be deployed where it saves time and money, no intermediary required. What would that look like in practice? Think of a U.S. bank treasury desk initiating a cross-border payment over ISO 20022 messaging, then using Ripple-powered solutions to source liquidity and complete settlement in seconds. The customer experience is a faster, cheaper cross-border transfer. The bank experience is better control over FX, funding windows, and reconciliation. Swift remains a messaging backbone for many corridors, but liquidity and finality can move to a network that does it more efficiently. Multi-rail, not winner-take-all. Meanwhile, the ETF conversation is heating up. In a recent interview, an ETF issuer executive suggested that first-day inflows for an XRP product could reach into the low billions of dollars if the structure clears US approval. Treat that as a scenario, not a promise, but understand the implication. Day one assets of that size would demand professional market making, tight primary-secondary arbitrage, and deep underlying liquidity. For the spot market, that means cleaner spreads and more orderly price discovery when flows arrive. For volatility, it means sharper reactions around key levels as hedges rebalance. If you want a concise, printable XRP thesis, one-pager, levels and invalidations, how ETF plumbing interacts with spot liquidity, and a simple bank integration checklist, write thesis in the comments and we'll prioritize it in the next update. Now, the cultural spark that keeps this narrative alive, public figures acknowledging XRP by name. Clips circulating online show high-profile voices referencing Ripple, XRP, and its leadership. Take all of that with the right filter. Attention isn't adoption, but attention does accelerate adoption when the plumbing is ready. Markets won't re-rate because of shout-outs. They re-rate when institutions push real volume through rails that work. Which brings us to tokenization and real-world assets. U.S. fintech leaders are openly saying it's time to move beyond headline coins and into tokenized financial products. Funds, deposits, collateral, and payment instruments that settle 24/7 with rich metadata. That's exactly where ISO 20022 and XRPL's design intersect. Structured messages that carry more context, plus a bridge asset built for fast, predictable settlement. If banks and asset managers lean into tokenization at scale, they will need neutral liquidity to stitch jurisdictions together. XRP's job is to be that liquidity, reliably and compliantly. Let's talk mechanics for the weeks ahead. If Ripple's parallel to Swift strategy is winning, you'll see it first in the data, not the discourse. 3 dashboards matter. First, structure on the chart. Reclaim and hold key round numbers through full session closes. Convert near-term resistance into support. $3 handles and mid-threes are the proving grounds. Attack prior supply bands with expanding spot volume. Without these confirmations, narratives remain just that. Second, derivatives posture. Rising open interest with stable funding signals healthy risk-taking. Rising open interest with overheated funding under resistance signals a squeeze setup. not a durable trend. Let the terms tell you when to press or to wait. Third, exchange flows and balances. Net outflows after red sessions are constructive. They imply accumulation. Net inflows into strength warn of supply that can cap breakouts. Watch balances at the end of the US session and into Asia. They often foreshadow the next move. Where do ETFs fit into this framework? If approvals arrive on a compressed timeline, expect a tug-of-war between primary creation flows and secondary market positioning. Good ETF plumbing can tighten spreads and deepen liquidity. Poor plumbing can produce noise around the open and close. Either way, price will respect levels when liquidity is thick and overshoot when it's thin. Preparation beats prediction. Define your ads, trims, and invalidations before the headline prints. The chosen one phrase carries baggage, so let's strip it to first principles. Payments modernization is happening with or without any single asset. ISO 20022 reduces friction by standardizing richer messages. Real-time rails move value more often in smaller increments. Institutions want finality, uptime, and compliance tooling. If Ripple Stack helps banks achieve those outcomes more cheaply than legacy alternatives, volume will find it. If XRP provides the most efficient neutral bridge across currencies and jurisdictions, liquidity will accrue to it. That's the test, performance, not mythology. Finally, a word on SWIFT. It remains a powerful network with global reach. But reach and settlement are different things. The most likely end state is a multi-rail world where institutions route by economics and compliance, not by brand. Ripple can win by making settlement faster and more predictable. SWIFT can win by making orchestration smarter and more interoperable. From an investor's perspective, the key is not who beats whom. It's whether XRP is the asset that captures the rising demand for cross-rail liquidity. To summarize, public acknowledgments spark interest, ETF talks spotlights plumbing, and the real game is bank-grade adoption under ISO 20022. If the next few weeks deliver structural breakouts on the chart, steady derivatives posture, and constructive exchange flows, the market will start to price the thesis, not just debate it. Tell us whether you think Ripple should run parallel to SWIFT or aim for convergence. And list the top 3 signals you want us to track daily: levels, funding/open interest, and exchange balances. If you want that printable thesis one-pager, comment thesis and we'll publish it in the next update.